Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Sunday. It is January the 15th, so we're already halfway through January, halfway through the month. So far, if you're an energy investor, it's probably been a good month, but I am not going to talk about energy stocks or, in fact, I'm not talking about stocks at all in this particular video. What I am going to do is spend a few minutes talking about fixed income. Now, for many of you, this will probably be less interesting, and especially for people who are younger. You're not looking really at fixed income, you're looking for growth and return on assets or return on investments. So this is educational. If you're interested, great. If not, maybe skip to the next video. But let me kind of quickly sort of walk you through here. I just want to show you what happens, when an issuer issues a fixed income opportunity for you to invest in. Very frequently, as you can see at the top here of this PDF, it is a 30-page prospectus. And many people will not read the 30-page prospectus. What they will do is just look at the sort of sales pitch. And sometimes that sales pitch is not even very, let's call it detailed or diligent. So in this particular example, which is a real example, this email was sent on January the 13th at 3:30 in the afternoon. And obviously I've redacted the sender because I don't want to diss anyone, and basically just using this educational video to make sure you kind of know what you're getting into. The subject matter of the email, so the subject line says, energy sector structured note yielding 15% pays monthly. That's the subject. And then the actual text of the email, and this is the whole email, the entire email, per the attached, we will be offering a similar note next week. Please let me know if you're interested. Have a great weekend. That's the sales pitch. A subject line that says, hey, this note yields 15%, and a one-liner that says, hey, let me know if you're interested. So what is this actual note that they are selling here as an investment for people? And very frequently, the people who are buying fixed investments are seniors, and very frequently they are dealing with someone that they feel they trust, a financial advisor or wealth manager from a major financial institution. I mean, how can you not trust your financial advisor from your favorite bank, right? He's just selling you a product. And at the end of the day, it's probably going to be in favor of the bank as opposed to in favor of the investor. But hey, not always. And some of these investments are well suited to certain people. In this particular instance, the issuer is Barclays. Barclays is a bank in the United Kingdom, headquartered in London, and they are selling a note for a minimum denomination of $1,000 or multiples thereof. So you need to have at least $1,000 to invest in this particular note, which is an asset that you can invest into, and then it pays you the coupon, which is another word for dividend, on an annual basis of 15%, and it's paid monthly. So what I'm going to do is I'm just going to gloss over some of the things that you want to look at when you see a prospectus of this nature. You don't have to read all 30 pages. Ideally, you should maybe even read it 2 or 3 times before you make a decision to invest. But I'm going to kind of show you the highlights reel. So in this particular instrument that they're selling here, this note, they have 3 reference assets, and we will know these as energy investors because they are ExxonMobil, Chevron, and ConocoPhillips. So those are the reference assets. Now they use a whole lot of terms in this prospectus, which you might not be familiar with. And as you read through it, you should become more and more familiar with them and know what they mean as you go along. Right at the bottom here, it says, if the final value of the least performing reference asset is greater than or equal to its barrier value. So now you already have multiple lines that you need to pay attention to. So the reference asset has to be greater or equal to its barrier value. You will receive a payment of $1,000 per $1,000 principal note. What they're saying is, effectively, if these equities, these publicly traded equities, Exxon, Chevron, and ConocoPhillips, go up, in other words, if they are greater than or equal to its barrier value, I'll get into that one in just a minute, for every $1,000 that you invested, you will get $1,000 back, regardless of what the stock is doing at that moment in time. Then it says payment at maturity. If the final value of the least performing reference asset is less than its barrier value. This is important for you to note because even though they're using 3 reference assets, what they are doing is they're saying we're looking at the least performing one. And if that one, that particular asset, so let's say ConocoPhillips, is trading at less than its barrier value, you will receive an amount per $1,000 calculated as follows: $1,000 plus $1,000 multiplied by the reference asset return of the least performing reference asset. So if Conoco is trading at about 60% of what it was trading at as a reference asset at the beginning of this term, which is 10 years, then you are going to get $1,000 multiplied by 0.6, which is $600 for every 1,000 that you had invested. The other thing to take note of is the agent's commission, which is 3%. So you're already starting at a somewhat, maybe I can phrase it as a disadvantage. For sure, you're buying into the asset and immediately taking a 3% hit, which is almost like buying a new car and driving off the lot and losing 25% of its value the minute you drive off the lot, because now it's a used car. Well, that's how it used to work. Nowadays, people tell me used car values have actually gone up. The estimated value of the notes on the initial date, based on our internal pricing models, is $955.30 per note. So right off the top, you're taking a $45 haircut on your $1,000, which is more than 3%. It's actually about 4.5%. The contingent coupon, this is what people are buying, right? So in that email that I shared with you, the seller, so obviously your licensed financial advisor or wealth manager, is basically saying this coupon pays 15% and it's paying it on a monthly basis, right? So effectively what it's saying is for every $1,000 you invest, you're going to get a 12.5, so a $12.50 coupon or dividend, if you want to call it that, paid on the principal amount, which is 1.25% on the principal per amount. So times 12, that would be 15% per year. And then there are contingent coupon payment dates. Then you need to look at these to see when you would actually see your return on investment in terms of the coupon paying out. So here's where we get into the weeds just a little bit. And this is sort of page 6, 7, 8 in the prospectus. So if you didn't read the prospectus, you wouldn't know. You understand and accept that you will not participate in any appreciation of the reference asset. What that simply means is this: if Exxon, Chevron, or ConocoPhillips over the next 10 years doubles or triples in terms of its stock price, you get none of that because you were receiving 1.25% per month or 15% per year as a coupon rate. So if the assets go sky high at the end of the term, if all of them go up and they're all trading higher, you will just get $1,000 back for every $1,000 that you put in. But of course, during the period that you were holding until you exit, you were earning 1.25% per month, which is 15% per year. You can tolerate a loss of significant portion. If you want to invest in this, you should be able to, that's what this means, tolerate a loss of significant portion of all your principal amount of your notes. Now, I explained that briefly when I said it's the less valued or least valued reference asset. So I use the example of Conoco is trading at 60% of what it was trading at the start when you got in, then you will get $600 back. You understand and accept that you will not be entitled to receive dividends or distributions that may be paid to holders of any reference assets or any securities to which the reference asset provides exposure to. What that means is if Exxon and Chevron and ConocoPhillips pay a huge dividend, which they do on a quarterly basis, you get zero because remember, you're earning 1.25% per month. You understand further from a risk point of view and accept the risk that if the notes are not redeemed prior to the scheduled maturity date, these things get renegotiated all the time because people love buying these notes. And when I say people, I mean institutional investors. They buy them and then they resell them again, and then they renegotiate them, as we saw with Occidental, as it was renegotiating all its notes from time to time and bonds and so on. This happens all the time, right? So if the notes are not redeemed prior to the scheduled maturity, the payment at maturity, if any, will be based solely on the reference asset return of the least performing reference asset. You are willing and accept the risk that the notes may be redeemed prior to the scheduled maturity and that you may not be able to reinvest your money. It's locked. Your money is locked for the period in an alternative investment with a comparable risk and yield. So after 1 year, 2 years, 3 years, they can do whatever they want in terms of reselling and renegotiating the note, and you may not be able to invest your money into something else that has a comparable or commensurate risk and yield as what you had originally invested in. And you are willing and assume and able to assume our credit risk for all payments on the notes. In other words, if they don't pay you, too bad. So then they give you a few examples, and they say at the closing value on the relevant observation date, because remember there are many observation dates, they say, let's assume, because we don't know, right? Exxon is trading at $99, Chevron 65, etc. And then they say, example number 2, what if Exxon was trading at $70 and Chevron at $59 and Conoco was only at $40, right? So they give you a few scenarios so that you can kind of do some basic calculations on the back of an envelope, just trying to figure out whether you're going to make any money or not. And the total return on investments of the notes, as I said, is 1.25 per month. So it's paying monthly $12.50 for every $1,000 that you invest. Then you have the core valuation dates, and then they give you some modeling, which is additional modeling. They say the notes are redeemed on the third core valuation date as an example. And then they say, is the closing value of any reference asset less than its coupon value? No, yes, no. In other words, they give you a few different models. If the answer is yes, any of the reference assets are trading at less than its coupon value, in other words, yes, you will receive 0, right? So at that point in time, payment on contingent coupon payment, date for that particular period, whatever the case might be. So they give you a few different valuation models, but you need to do the homework, right? So it's not like the email from the seller who says, hey, here's a note that yields 15%, you want to buy it? And then people sometimes just don't take the time to actually investigate what it is that they are investing their money into, and they just go like 15%, yeah, I'll take it, right? Now, you've heard me say often in other videos, I'm trying to make 15% on an annualized basis because I'm not greedy. But I do hold some high dividend yielding stocks, right? So I talked about these many, many times before. Many of them are energy stocks too. If the stock is yielding 6, 7, 8% in terms of an annual dividend, and I get a 6, 7, 8% stock appreciation in addition, I'm at 15% also. So I don't need to buy this note with all its terms and conditions and criteria, which puts me at risk where I have absolutely no predictability and no protection. Now, what they're doing here is they give you a final value, and then again, it's modeling, right? Because we're working with assumptions here. They're saying if Exxon is at 140 and Chevron is 145 and Conoco is 150, then the reference asset return is 40%, 45, 50%. Of course, you get none of that, right? In other words, you're not getting a return on investment in terms of asset return, and you are not getting the dividends that are paid quarterly by the issuer. So Exxon, Chevron, ConocoPhillips, you are receiving from the issuer of the note, Barclays in this instance, 1.25% per month. That is it. And then the example down here says the final value of the reference asset A is 135, reference asset B is 130, and the final value of reference asset C is 140. Because reference asset B has the lowest reference asset return, reference B is the least performing reference asset. Because the final value of the least performing reference asset is greater than or equal to its barrier value, you will receive a payment at maturity of $1,000 per $1,000 principal amount. Okay, so I hope it makes sense. Other notes in terms of risk. Your investment in the notes may result in significant loss. So I kind of touched on that a few times when I used Conoco as the example, saying, let's say it's trading at 60% of its value. The potential return is limited to the contingent coupons, if any, and you will not participate in any appreciation of the reference assets. If the stocks go up, they keep it, not you. That's why they have been paying you at 1.25% per month or 15% per year for the period that you're holding it. You may not receive any contingent coupon payments on the notes, right? The issuer may not necessarily make periodic coupons. So in other words, they're exempt from doing it for whatever reason. And you have to accept that you can't do anything about it and your money is locked. Because the notes are linked to the least performing reference asset, you are exposed to greater risks. Anyway, you guys get where I'm going. I hope it's useful, right? So there are other factors as well. So I added this little slide here just at the end, just for interest rate changes, default or credit risk, secondary market liquidity risk. I don't want to get into any of those right now. What I wanted to do was just explain sort of at a high level, fixed assets and returns and commensurate risk and reward. So I hope it's helpful, at least to somebody. And thank you for watching. I'll be back soon with more. Take care. Bye-bye.